Hi, my name's Erik Hayden. I'm the founder of Urban Catalyst. Urban Catalyst is a real estate equity fund focused on ground-up development, and we're also an Opportunity Zone fund. And that means we're able to pass along the benefits of the Opportunity Zone tax legislation to our investors. It's very important for investors to clearly understand what fees they'll be paying when they invest into an Opportunity Zone fund or any type of fund. So I want to talk about Urban Catalyst fees to really give investors that clarity that they're looking for, to understand the underlying investment and the underlying returns that they'll get from that investment after fees. We're fund managers and we're developers. As fund managers, we only put money into projects where we're the developer. And that gives investors a lot of transparency when it comes to fees. Real estate equity funds in a typical fee structure charge a management fee, and then after the investor receives their money back, plus a return hurdle, say an 8% internal rate of return, there'll be a profit split. And that profit split can be anywhere from 60-40 to 50-50, where the investor would receive 60% of the profits above that 8%, and the fund manager would receive 40%. At Urban Catalyst, our fee structure is much less than that. We do charge a 2% management fee, and we do have an 8% return hurdle. So your investor gets your money back plus 8%, and then above that we have an 80-20 split, where Urban Catalyst receives 20% of the profits and the fund investor receives 80%. I mentioned that a lot of Opportunity Zone funds, they are fund managers, and then they partner with developers. And those developers also charge fees, but you can't see them because they're not clear in the private placement memorandum. At Urban Catalyst, you can see our developer fees very clearly, and we charge very standard developer fees. We charge a developer fee, an acquisition fee, a disposition fee, and a financing fee. To have the clarity and understanding of what our fees are is what's important when determining what type of investment you want to make and which fund you want to invest in. I want to talk to you about a complicated subject that occurs in a lot of Opportunity Zone funds, which I call the double promote. We talked about how Urban Catalyst is promoted at the fund level, which is very typical for fund managers. But what you don't see in a lot of funds that are investing in other developers is what type of promote the developer gets. In our private placement memorandum, you can clearly see all of our fees. Our fees describe we do not have any promote at the developer level. Some people call that the sponsor level. But when you sign up for XYZ fund, you might not be able to know if the developer is getting, say, 40% of the profits above a certain return threshold, and then the fund manager is getting X% of the profits above a certain return threshold. Opportunity Zone funds have to make economic sense, and a part of the due diligence process definitely includes looking at the fees of that fund. It's become very clear in the market that investors invest in funds that have lower fees. And that has been our philosophy here at Urban Catalyst. If you compare our fees to other Opportunity Zone funds out there, you'll find that we're significantly lower. For more information, visit urbancatalyst.com.